Charitable gifting comes from the heart and the soul of the giver. Maximizing the gift comes from the timing and the way the recipient receives the gift. There is a mixture of things you have to consider in charitable giving to optimize being a better giver. That means efficient giver. Right? You want to pay attention to the timing, to the taxation, and to the investment nature that you're passing on. We're going to talk about the best way to give your assets, the best way to give your resources to your churches, your charities. We're going to talk about it on Consider This Program today. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Adam Harter.
Happy to have you all along. Hey, for those of you who don't know Adam, he's our Chief Investment Officer at the Financial Enhancement Group. He is a chartered financial analyst. CFA is the credentials behind it. I'm a certified financial planner, so you're getting this from two different perspectives. And I don't know how old you are that are listening to the show, but I remember when I was a young man on Saturday mornings, conjunction junction, what your function would be on, and then they would talk about how a bill became a bill. And I always loved that history lesson of how things get invested and get created, and how how the Capitol Hill worked, and all of that other stuff. What I have found from teaching at Purdue for 7 years, being in this industry for 34, is some of the stuff that we just take for granted that Adam and I know aren't necessarily what everybody else knows. Now, the theme of the show for our Christmas special really is charitable gifting, and we are going to walk you through the life of an investment that we're going to look at, where we know at the end of the end, the intent is to actually leave that to charity, either upon our demise or gifts along the way, right? And we're going to deal with the fact that there is life. So, like in all things, I would remind you to write down the fiduciary focus. Here's the 4 things you're going to hear Adam and I talk about: the risk and volatility, the fees and expenses, the taxes, both today and tomorrow, and the real return of the investment. So, Adam, question number 1. If I knew I was going to leave this behind for charity, in your mind, would I buy a stock? And there isn't any right answer, and we may not even agree. Would I buy a stock or an exchange-traded fund?
Well, dang, you got me off guard with that one.
Yeah.
I'm probably going exchange-traded fund, but that's a broad term. So
It is.
A stock. It's that word that gets it, a stock. So if I'm giving to a charity, I want it to be there for them, and so I've got more certainty with the exchange traded fund. But I made 80-20 on that answer.
So what he did there, he went into the fiduciary focus, and he went with the risk and volatility. He really wants to make sure something's left behind. By definition, you take more risk with a singular stock than you do with a basket of stocks. Remember, there is a phenomenal difference between the basket of stocks in a mutual fund and a basket of stocks in exchange-traded funds. I'm not even telling you that it's fair, but it comes down to a tax impact. Inside of a mutual fund that you hold for a long time, you're going to be paying taxes along the way, where with the exchange-traded fund, you're not going to be paying any taxes on any appreciation or capital gains that are in there under the tax code today, right? So I could live with either of those decisions, not all exchange-traded funds,
right,
but most of them. I would probably say if I was really into the biotechnology space, and I'm convinced somebody's going to make it so that I don't have to work out. It's going to make me skinny, make hair grow, make eyes better. There's just too much money in vanity and in that kind of stuff. I would probably buy an exchange-traded fund that was a basket of biotech stocks, as opposed to try to pick one out. If there was a company that I thought was going to be around for a long time and really change the landscape, I might buy 10 to 20 different individual stocks more than the exchange-traded fund. And,
yeah, that's fair.
And that would be my preference, because we'll get to the tax planning side in the first place. So let's say we picked out our 20 stocks. So, you're a smart guy. They tell me I am. Right? We sit down and we look at this, and we fast forward where we think the world's going to be in 20 years when we intend to make the gift, right? And so we've picked out these 20 stocks that we've got, right? Now, we have to deal with the reality of life. Not all things that we pick go up, right? And That's hard for professional money managers to talk about on radios. Adam and I have to be losers every day. And when I explain this to people, they look at me and go, "What?" So think about this, right? So we've talked before. We own Apple. We've owned Apple since 2006. We're long Apple. All the securities regulations say we have to tell you that. That's not a thing to tell you to go buy it or sell it today. And we're just telling you we own it, right? So when Apple becomes more than 5% of your portfolio, Adam and I have that heart-to-heart talk, and we know that we have to sell some of the stock. That means taxes, right? There's just no way around it. We can't let one company become more of 5% of your portfolio. We believe that is undue risk, and part of our job is to mitigate risk in your portfolio, right? So we're going to go in and sell that. And now think about what happens the next day, right? In our case, it's minutes after, right? Either we sold a stock that just went up, and people are going, "What in the world are you thinking, Clark? You know what? Why would you do this?" And I go, "Well, it's Adam's fault."
Yeah.
All right. That's how we function. Or we sold part of it and the stock goes down. And, the next question is, "You dummy, why didn't you sell it all?" Right.
Yep.
And you and I have lived through that countless periods of time. But this is why I would have the 20 individual stocks as opposed to the exchange traded fund. All right. Now, side note, if you went back 10 years ago, I wouldn't have told you to have the 20 different stocks. I'd have told you to buy an exchange-traded fund. But in the world we live in today, there's no trading costs, right?
Yep.
So even if you only had $500 or $1,000 in each one of those 20 stocks, what's going to happen, we're 5 years into the deal, and one of them has moved above 5% of your portfolio, right? We'll just call it the fruit company, right? And this other one that we thought was going to be great, that still might be great, is down 20%. Right. So on paper, you've got a capital loss. Right. So remember, go ahead and walk them through what basis means, what that, and how you would explain to your kids what tax basis means.
Well, tax basis is what you paid to purchase the stock. And so if going back to day one, and if we had 100,000, when we put 5,000 into each of the 20, that $5,000 is our tax basis, is what we paid for it.
And because we bought individual stocks, it's divided amongst them individually. So yes, you've got a basis in the whole portfolio, but now it really only matters per holding, right? So we've got our fruit company that we bought that's now worth $6,000. And we've got another company that we bought that's only worth $4,000, right?
Yeah.
If we sell the fruit company, we have what's called a long-term capital gain. If we held it for 5 years, if you hold it more for a year and a day, it's a long-term capital gain. Right? Could be taxed as much as 20% on the federal level, right? Probably less for most people, but it could be taxed at 20%. What happens with the stock, Adam, that is down from 5,000 now down to 4,000? It's unrecognized. What does that mean?
Well, so it has a loser. Just as a quick, going back to your investment point, just put a little bow on that, by the way. If you there's a collection of book out there called Market Wizards. It's been an account of all the best investors. And by the way, if you look at the sum of all those great investors, they average about a 51% win rate. You have about as many losers.
And these are the wizards.
These are the wizards. It's all about how you manage the losers. Is basically what it comes down to. So in the loss, that 5,000 that became 4,000, you have a loss, and you have an ability to sell that and to use it to offset your gains.
Don't say that so lightly, because that's the part you have to do something.
Yeah.
Right? You got to do something.
Yeah, you actually have to sell it and be willing to part with it for at least 30 days.
And then you can buy it back.
Right.
And so now you have a loss that offset your gain. So you paid no taxes. If you work with somebody like us that has no trading fees, you have no trading cost, right? So the reason you bought those 20 stocks was so that you could look at those individual bases. We call it harvesting losses. And people have always looked at me and said, "Joe, why in the, she's a CPA, doesn't work at the firm anymore, but used to be up at the Lafayette office. And she came in one day. She was not one of the partners, so she's not in meetings with me. She's in the back office, but she came in one day and she goes, "I don't get it." This is probably 7 or 8 years I've been with Huth Thompson. She goes, "I don't get it. You lose money for people every year and they love you." right? And, there are a lot of people who do what Adam was talking about. It's called tax loss harvesting. A lot of people do that today. They didn't in 2005 and 2006, and we proactively would do that and scour places to be able to offset gains, to make people more tax efficient, to step up bases, to do those kind of things. And when I explained to her that we intentionally harvest our losses because we weren't trying to hide our failures, we knew that they would happen. And, we were trying to help edify or enhance, if you will, the successes that we had with the ones that did well. And that's really where that tax loss harvesting comes into play. And Adam and I will tell you this year, I don't care if it's us or if it's somebody else, if you're working with a good registered investment advisor and not somebody who's selling you mutual funds, but even maybe if you own those, and we're not talking about IRA money, we're talking about money where your annual tax basis is exposed every year, right? You need to be aware that you may have more long-term capital gains this year than normal, because there's been a lot of rotation that's taken place in the market between value and growth, and you still have a handful of companies that are driving it. Right?
Yeah.
All right, so now we get to 65, and we talk about giving the stock away, right? So one of those stocks that is down, should I ever give the stock that's down in value away to a charity?
No, absolutely not.
Never. You want to sell it and recognize the capital loss, right?
Yeah.
Now, the other stock that's up, do I give that one away?
Absolutely.
What if I love that stock?
Well, you give that stock to the charity, use your cash to repurchase the stock. Or even if you didn't want to part with cash, maybe you take the loser that is no longer worthy of the spot in your portfolio and buy the winner. Take its spot.
Now, you told me I had to wait 30 days.
You do have to wait 30 days to repurchase the losing stock. You don't have to wait 30 days to repurchase the gain. You can do that instantaneously.
Ding, ding, ding. And you'd be amazed the number of people who confuse that. One last thing as we're going into the holidays and the end of the year, remember, carry forward loss stays on your tax return forever if you have those losses to be able to use, but they also disappear if you pass away. So make sure that you're using them. I've watched people die with $200,000 for the capital loss on a tax return. Their wife's still here, right? Now that's capital loss is technically $100,000. You lose half of it when they die. Make sure that's being used if you've got somebody in hospice or in a terminal illness situation. Take advantage of that from a tax perspective. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. We look forward to sitting down for your next steps meeting. yourlifeafterwork.com.